What if I told you that a 150-year-old financial experiment, a massive distortion that has been sitting at the very heart of our global monetary system, is failing? That this long-running, completely artificial arrangement is not just cracking, but is collapsing right now, in real time? Well, all the evidence is pointing to exactly that.
For literally all of recorded human history, the relationship between gold and silver was incredibly stable. From the time of the pharaohs, through the Roman Empire, all the way to the founding of America, it took about 15 ounces of silver to buy 1 ounce of gold. It was a natural, monetary law. But just look at where we are today. It takes around 75 ounces of silver to get that same ounce of gold. This isn't just a minor market fluctuation. This is a 5-fold departure from a standard that stood for 5 millennia.
So, this obviously raises a couple of massive questions. First, how on earth was a relationship that stood the test of time for 5,000 years so completely shattered? And maybe even more important for us today, what powerful forces are causing it to violently snap back toward its historical average right now? Because let me be clear, this was no accident. It was a deliberate choice.
To get the answers, we have to travel back in time. We need to investigate the scene of the original financial crime, a single event that took place a century and a half ago that paved the way for the entire monetary system we live under today.
This timeline really shows you the exact moment the break happened. For thousands of years, you see this incredible stability. The United States even codified this natural 15-to-1 ratio into law with the Coinage Act of 1792. Gold and silver were both money. Then, suddenly, in 1873, one single piece of legislation came along and shattered everything.
That legislation was the Coinage Act of 1873. In history books, it's often called the Crime of 73, and for good reason. It officially stripped silver of its status as money in the United States. Now, why would they do this? Well, it just so happened to benefit very powerful international banking interests who preferred a system based only on gold, a much scarcer asset that was far easier to centralize and therefore to control.
And here is the single most important consequence of that act. Removing silver as a monetary anchor was the first critical step in breaking the link between money and tangible assets. It paved the way for the global fiat system we have today, a system where money is backed not by gold or silver, but simply by government decree. And when your money is backed by nothing but a promise, you can create as much of it as you want. That is how you end up with the staggering levels of debt we see today, like the U.S. national debt screaming past $38 trillion.
So, that engineered system, that artificial construct, held together for 150 years. But any system that defies natural law has a breaking point. And the numbers we are seeing right now, today, strongly suggest that we have finally reached that limit. The whole thing is beginning to unwind.
Just a few short years ago, the ratio hit an all-time mind-boggling high. It took 125 ounces of silver to buy just 1 single ounce of gold. This was the moment of maximum distortion, the point where the rubber band had been stretched to its absolute limit.
Okay, now let's look at what's happening this year. Gold is having a spectacular run, up over 60%. And this makes perfect sense. We're seeing a massive trend of de-dollarization around the globe, and central banks are responding by buying physical gold at a record pace. Gold is behaving exactly like the ultimate safe haven asset that it is.
But here's where the story gets truly explosive. Silver is up nearly 94% year-to-date. It isn't just following gold higher, it is dramatically outperforming it. This is the coiled spring that people in this space have been talking about for years. And friends, it is finally, powerfully being released.
I mean, this chart really says it all, doesn't it?
A 60% gain in gold is a massive bull market in its own right, but silver's performance is on an entirely different level. This isn't just another cyclical move. This is a clear signal of a deep, structural repricing that is happening right before our eyes.
What we are witnessing is a textbook example of one of the most powerful forces in all of finance: reversion to the mean. It's a simple idea. When you artificially pull something far away from its long-term average, its eventual return to that average isn't just likely, it's often violent and swift. And a 15-year distortion is about as far as you can pull anything.
So that brings us to the big question. Why now? Why after 150 years is this finally happening? Well, it's not because of any single thing. It's the powerful convergence of three massive, unstoppable forces that are fundamentally and permanently changing the silver market.
These three forces are: first, an absolute hyperdrive in industrial demand. Second, the death of the paper market mechanism that has suppressed silver's price for decades. And third, something few are talking about: the official return of silver as a monetary asset in a key part of the world. Let's break down each one.
First up, industrial demand. The entire global green energy transition and the digital revolution are physically impossible without silver. It's not a nice-to-have, it's a must-have. Every solar panel, every electric vehicle, every 5G tower, and every AI data center requires massive amounts of it. This isn't speculative demand, it's essential, non-negotiable demand from the world's biggest industries.
And what's the result of this voracious demand? Well, for the fifth year in a row, the world is projected to consume far more physical silver than is being mined out of the ground. We're talking about a deficit of over 200 million ounces in 2025 alone. You simply cannot sustain a physical shortfall like this year after year. At some point, the price has to rise to reflect the raw physical scarcity.
The second driver is the end of an old game. For decades, the silver price was largely controlled by the sale of paper silver, futures contracts, and derivatives that were essentially IOUs for metal that the sellers didn't actually have. Big banks could dump billions of dollars of this paper silver onto the market to crush any rally. But new international banking regulations, known as Basel III, have made that game of selling unbacked metal far too expensive. The paper tiger has finally lost its teeth.
And this brings us to the third driver, and this one is a true game changer. It's a seismic policy shift that is going almost completely unnoticed. India, the world's single largest consumer of physical silver, is officially remonetizing it. Their central bank is now allowing commercial loans to be backed by silver as collateral. This will instantly unlock the monetary value of thousands of tons of privately held metal, effectively bringing it back into the formal financial system.
So, with these three powerful forces all converging at once, what could a revalued silver actually look like? Let's forget speculation for a moment and just look at two very conservative scenarios based on where gold is trading today. If the ratio simply returns to its 20th century average of 40-1, a period when silver was primarily viewed as just an industrial metal, that would imply a silver price of $105 an ounce. But what if it undergoes a full reversion to its 5,000-year historical role as money, back to that 15-1 ratio? Well, that implies a silver price of $280 an ounce. And remember, both of these scenarios are based on gold staying right where it is. So, let's put it all together. The key takeaway is this: the suppression of silver was never a free market outcome. It was a deliberate policy choice made a long time ago. That choice created a huge structural imbalance between the paper price and the physical reality. And what we are seeing today is that imbalance being violently unwound by fundamental forces that can no longer be contained.
When you combine relentless must-have industrial demand with the official reintroduction of silver as a monetary asset, you have a truly explosive setup. So the question is no longer if this 150-year-old anomaly is going to correct itself. The only question left to ask is, how quickly is it all going to happen?